Japan, known for its strong economy, has used special methods for a long time to handle its money problems. These methods included keeping interest rates very low, sometimes even below zero, and controlling how much its currency is worth compared to others. But in 2024, things started to change. For the first time since 2007, Japan decided to raise its interest rates, showing that it's ready to try something new. After World War II, Japan's economy grew fast, but then it hit a period where it stopped growing, no matter what experts tried to do. This story is about more than just money. It's about people's dreams and how Japan connects with the world's economy. The big question now is, what led to this big change in Japan's money policy? And what will happen next, not just for Japan, but for everyone who deals with Japan in business?
The BOJ has done exactly what the market expected it to do, getting rid of YCC, also making an exit from negative rates.
Well, the Bank of Japan, the BOJ, is raising interest rates for the first time in 17 years today, making it the last major central bank to exit the world's negative rate policy.
Japan's approach to managing its currency began taking shape decades ago. After World War II, Japan was on a mission to rebuild and grow its economy. To do this, it needed a stable and manageable currency. For many years, Japan kept a tight grip on how much its currency, the yen, was worth compared to others. This helped Japan sell its products abroad at competitive prices, boosting its economy. In the 1980s, the world saw Japan's economy skyrocket. It was a time of big profits and rapid growth. However, this success didn't last forever. By the 1990s, Japan's economy hit a rough patch, entering a period of slow growth that lasted for years. This is often called the lost decade. To fight this, Japan's government and its central bank, the Bank of Japan, started using some bold strategies. They lowered interest rates, making it cheaper for people and businesses to borrow money. Alongside these measures, Japan also began to directly influence the value of the yen. By buying and selling huge amounts of currency, they tried to keep the yen's value at a level that would help Japanese exporters. This was all done in the hope of sparking life into the economy and getting back on a path of growth. This strategy of intervention has been a cornerstone of Japan's economic policy for many years. It was a way to protect its economy from big ups and downs in the global market. But as we move into a new era, the shift away from these long-standing policies marks a significant change in how Japan plans to navigate its economic future. Japan's economic toolkit includes some unique strategies like yield curve control, YCC, and negative interest rates. These tools are not commonly used worldwide, making Japan's approach stand out. YCC focuses on the interest rates that the government pays when it borrows money for different lengths of time. Normally, these rates change based on how investors feel about the economy's future. With YCC, Japan's central bank, the Bank of Japan, sets a target for these rates, especially for 10-year government bonds. It buys or sells bonds to keep the rates around this target. Negative interest rates are even more unusual. Banks usually pay you interest when you save money with them. But with negative rates, it's the opposite. You pay the bank to keep your money. This is supposed to encourage people and businesses to spend or invest their money instead of saving it. Japan introduced this policy to fight deflation, a situation where prices keep falling and economic growth stalls. Both these tools aim to stimulate Japan's economy. By controlling interest rates closely and even pushing them into the negative, Japan tries to encourage more spending and investment. This, in turn, is supposed to help the economy grow and avoid long periods of no growth or deflation. However, these are complex and sometimes risky strategies that have sparked much debate among economists and policymakers about their effectiveness and long-term impact. For years, Japan battled deflation and sought ways to kickstart growth. The world watched as Japan's innovative yet risky monetary experiments unfolded. But as the global economic landscape evolved, so too did the challenges Japan faced. The decision to raise rates was a response to these challenges. It signaled Japan's readiness to normalize its monetary policy, reflecting improvements in the economy and a desire to move towards a more conventional approach. This was a clear message that Japan was adapting, seeking to balance the need for economic stimulation with the risks of prolonged ultra-loose monetary policies. The 2024 policy shift was not just a change in interest rates, it was a statement about Japan's economic future. It showed a willingness to step into uncharted territory, leaving behind old tools and strategies that no longer serve their purpose. This move has significant implications for Japan's economy, affecting everything from consumer spending to the global perception of Japan as a financial leader. This change had a lot of effects, not just in Japan but all over the world. First, people who invest money started to look at Japan differently. With higher interest rates, putting money into Japan seemed like a better idea. This meant some investors might pull their money out of other places to invest in Japan instead. Also, the value of Japan's money, the yen, went up. When the yen is stronger, things Japan sells to other countries become more expensive. This could make it harder for Japan to sell its products abroad. Japanese companies that sell things overseas might have to find ways to keep costs down or focus on making special, high-quality products. Other countries paid close attention to Japan's move. If Japan, known for keeping interest rates very low, was changing its approach, other countries might think about doing something similar. This could lead to changes in how money is borrowed and spent around the world. Back in Japan, this change could help with some big challenges, like its huge national debt. Higher interest rates might encourage people to save more, but there are also some tough spots. Things like loans for houses or starting businesses might get more expensive, and with an older population, Japan must think carefully about how these changes affect everyone. In the end, Japan's decision in 2024 was a major step. It could lead to a stronger economy in Japan and influence how money is managed around the globe. A stronger yen and higher interest rates could help Japan deal with its huge public debt. For years, Japan borrowed a lot of money to keep its economy going. Saving money could also become more attractive. When interest rates were super low, saving didn't seem worth it. But with rates going up, people might start putting more money into savings accounts. This could be good for the economy in the long run. As Japan steps into this new era with higher interest rates and a stronger yen, it's looking at a future full of possibilities and challenges. This shift is not just about changing numbers on a board, it's about moving towards a healthier economy. But what does this future look like, and how can Japan navigate it successfully? First, Japan's businesses, especially those selling goods around the world, will need to adapt. With a stronger yen making their products more expensive abroad, they might focus on innovation, creating things that are so unique and high quality that people are willing to pay more. This could spark a wave of creativity and new ideas in Japan's industries. Next, the government has an important role. It can support businesses and people as they adjust to these changes. This might mean helping companies that want to innovate or making sure there are good jobs for people in industries that are changing. The government also has a chance to reduce its huge debt thanks to higher interest rates making saving more appealing. For regular people in Japan, this new landscape means thinking differently about money. Saving could become more popular again, offering a way to secure their future. But people will also watch closely to see how the economy is doing, especially if borrowing money for things like houses becomes more expensive. Looking ahead, Japan is hoping that these changes will lead to a stronger, more balanced economy. The goal is not just to grow fast, but to grow in a way that lasts and makes life better for everyone. This means being ready to face some short-term challenges in the hope of a brighter future.